Good evening, everyone. Welcome to this webinar where our Senior Portfolio Manager, Yo Wei-Ren, will be sharing updates on the performance and portfolio changes of our managed portfolios, FSM maps, in the first quarter of 2022, and how you can position your portfolios amidst current challenging market conditions. Throughout the webinar, if you have any questions, feel free to key them in the Q&A Zoom function, and he'll be addressing them after his presentation. So now I'll pass the time over to Wei-Ren.
Thank you, Sarah, and good evening, everyone. My name is Wei-Ren. I serve as Senior Portfolio Manager at iFast, and I'm also part of the team that helps to oversee the FSM managed portfolios. So today I'd like to give everyone an update on the performance of our MAPS portfolios in the first quarter of 2022, as well as some of the portfolio changes that we have done over the past few months. I'll also be going through our market outlook for the year and how we will be positioning our portfolios moving forward. And after my presentation, we will have time for Q&A. So if you have any questions that you would like me to address, please feel free to make use of the Zoom's Q&A function. So I'll start off my sharing today by first giving everyone an update on the performance of our MAPS portfolios. So if you have been hoping for a good start to the year, then you would have been very disappointed because the first quarter actually turned out to be quite a challenging one for both equity as well as bond markets. So if we look at the performance of the MSCI AC World Index, which measures the performance of global equities, so this index was actually down by 4.8% in the first quarter, which is actually not too bad considering the fact that investors have been facing quite a number of market risks over the past 3 months. But you can see quite obviously that this 4.8% decline was not without its ups and downs. There has been quite a bit of a volatility in equity markets over the past quarter. At the start of the year, we were confronted with higher than expected inflation and also the prospect of a faster than expected tightening by the Federal Reserve. So that triggered a sell-off in global equities, and the sell-off was particularly concentrated in the tech sector, because tech stocks in general, they tend to be challenged in a rising interest rate environment, especially the loss-making tech stocks. And after that, in the month of Feb, Russia invaded Ukraine, and that caused another round of sell-off in the global equity markets. But interestingly, after just 1 month since Russia has invaded Ukraine, global equities has actually started to rebound. And you can also see that because of this perceived improvement in the situation in Ukraine, the MSCI World Index has in fact recovered all its losses that were incurred since Russia invaded Ukraine. And the data over here is as of 31st of March. So the index is now comfortably above the point when Russia started to invade Ukraine. So market performance, of course, across the various geographical regions, it was very uneven, as we can see very clearly from this chart. So some markets did exceptionally well in the first quarter, including the likes of your Brazilian equity market, which has benefited from a rally in commodity prices, as well as markets in the ASEAN region, which includes Singapore. They have all outperformed global equities, and they have also managed to deliver positive gains at a time when stocks have mostly been going down across the world. So for ASEAN, that's really because of the reopening wave over in this part of the world. And ASEAN stock market in general is made up of companies that are from the financials and energy sectors. And these sectors have generally benefited from the reopening. Singapore is a good example. If you look at the Straits Times Index, a big part of it is actually made up of our 3 local banks. So financials are a big part of the Singapore equity market, and we have benefited from this value rotation this year. So same thing for the other economies in the ASEAN region. And on the other hand, you see Russia's equity market being wiped out by the war and the sanctions. This is the performance of the MSCI Russia Index. So this index is in fact wiped out by the war and sanctions that were being imposed on Russia. And over in Feb, trading in Russian stocks was actually suspended during the quarter. So foreign investors were in fact banned from selling their Russian assets. So if you have invested in Russia, then chances are you would have lost almost every single cent of your investment. China also continued to underperform, and this was primarily due to due to a lot of factors actually. The first of which is, of course, China's relationship with Russia, because markets were very worried that China could also potentially come under Western sanctions because of its ties with Russia, and because investors woke up overnight to find their Russian assets becoming worthless. They are all afraid that that could happen to their Chinese assets as well. So that contributed to the sell-off in Chinese assets. Over the month, there was also the potential delisting of your US listed Chinese companies. So there was another development that affected sentiment. And also more recently, there was the renewed COVID lockdowns in China, with Shanghai being the most prominent example because of its importance to China's economy. So all of these factors have contributed to a sell-off in the Chinese equity market. Fixed income markets also didn't do as well in the first quarter because of rising expectations for the Fed to hike interest rates aggressively in order to bring down inflation. In fact, if you look at the performance of all the major fixed income segments, you realize that every major fixed income segment in the world, they have registered losses over the quarter. So in terms of our portfolio performance, so we underperformed our benchmarks in the first quarter because of our tech exposure, which was affected by expectations for rising interest rates. So some of the active funds that we have in the portfolio, they have underperformed. And the renewed volatility in the Chinese equity market has also affected our performance because of our exposure to Asia as well as the Chinese equity market. So if you look at our performance on a 3-month basis, we have actually delivered losses of between 6.6% to 12%. And also, if you look at our performance since inception, our portfolios have in fact delivered annualized returns of between 1.5% to 7.2%. So at this point, I just want to bring your attention to the huge divergence in performance between the MAPS portfolios as well as our underlying benchmarks. So compared to the benchmarks, this is of course a very big difference. And the reason for this underperformance is really because of our exposure to China. So China, if you can recall, they were actually the worst performing equity market in 2021. And 2021 was, in fact, an exceptionally good year for global equities, especially the US equity market. And this significant underperformance of Chinese equities actually weighed on our performance in 2021. And in the first quarter, if I may just scroll back to this chart on the performance of the individual equity markets, apart from Russia, China was also the worst performing market in the first quarter. And our benchmark, on the other hand, is actually the MSCI AC World Index for the equity portion. And this index is predominantly made up of US equities. Our allocation, our portfolio allocation, on the other hand, it's more skewed towards Asia and emerging markets. And China is, of course, a big part of these two markets. So China is one of the primary reasons that explains our underperformance. And I'll, of course, be discussing some of our views on China in the later part of my presentation. So for our income portfolios, we have also delivered losses across the 5 portfolios in the first quarter. So our losses also ranged from about 6.7% to about 10.7%. So if you compare the performance of our income portfolios to the growth portfolios, then you realize that the income portfolios is actually a bit more resilient, because for the income portfolios, we do have some dividend-oriented strategies inside the portfolios. And these dividend funds, they have been holding up relatively well in the first quarter of this year. But since inception, we have delivered annualized returns of 1.4% to 6.5%. And similar to our growth portfolios, our income portfolios have also lagged behind their benchmarks by quite a wide margin, unfortunately. And China is, again, the key contributing factor to our underperformance. In terms of individual fund performance, so most of our developed market equity funds actually underperformed their benchmarks. So the reason for that is because of their tech-related exposures. So we have exposure to the O-shares Internet Giants ETF. So this one has been caught up in a sell-off this year. It is down by about 23%. And we also have exposure to the Lake Mason Clearbridge, large cap growth, Allianz European Equity Growth, and also the JPM Japan Equity Fund. So these funds that I've just highlighted, they are actually all overweight in tech-related investments. So their performance so far this year has not been very favorable in the first quarter. So we have actually made some changes to our portfolios over the past few months to try to inject a bit of resilience into our portfolios. So one of the things that we did was to bring in value-oriented strategies. So if you look at this table, we have in fact brought in funds like the US Value Fund, as well as the HSBC Europe Value Fund. So if you look at the performance of these two funds, they have in fact been holding up relatively well compared to some of the other funds inside the portfolio that are more skewed towards growth-related stocks. For our emerging market equity funds, they also didn't do well. The only exception here is our exposure to Latin America. This one is up by close to about 24% in the first quarter. And that's really because Brazil is a key commodities exporter. So its stock market has benefited from the sharp rally in commodity prices. We also have the Fidelity EMEA fund inside our portfolio. And on a year-to-date basis, this fund has actually dropped by more than 40%. And the reason for that is because of its exposure to Russia. So before the Russia and Ukraine war, this fund had about 30% exposure to Russian equities. But as we all know right now, Russia invaded Ukraine and they actually banned foreign investors from selling their Russian securities. So what happened to this fund was that its Russian holdings, they are illiquid. The fund manager can't sell it at all. So these Russian holdings, they have been subjected to fair valuation. And as you would expect, the fair value for Russian securities at this point is effectively zero. So most of its Russian holdings, they have been written off. And as of the 31st of March, this fund's exposure to Russia was only about 1.7%. Based on the fund manager's latest communication with us, moving forward, they do not intend to make new investments in either Russia and Belarusian equities. And what they will be doing is that they will be shifting their attention to the stock market in South Africa, which they expect will benefit from surging commodity prices. So internally for the portfolio management team, we are currently reassessing this allocation to the EMEA region. But we are also not in a rush to take this fund out of the portfolios because all of its Russian holdings, they have effectively been written off, which means that the fund will benefit if there are any improvements in the Russia-Ukraine situation. And the fund now has a substantial exposure to commodity-related stocks. And this can help to provide a bit of inflation protection to our portfolios. So as of now, we are still evaluating the case for having an exposure to the EMEA region, but for now, we are still keeping this fund in our portfolios. In terms of our tactical ideas, I would say it has been a mixed bag so far this year. Our exposure to financials and semiconductors, they have not done well. But our exposure to the China AMC Hong Kong Banks ETF, so this one has delivered strong gains for us over the quarter. And over the past 3 months, we have also added exposure to commodity-related stocks. And we have used the JPM Global Natural Resources for that exposure. We included this fund only in March, so this 11.3% gain that you see is effectively a 1 month performance. Bonds underperformed equities this year because of rising expectations for the Fed to bring inflation down. So because of this expectations for aggressive interest rate hikes, all of our fixed income funds, they have actually registered negative returns so far this year. And such was the volatility in fixed income markets that even the likes of your United SGD and also the Lion Global short duration bond, they have all fallen by around 2% in the first quarter. And for those of you who are familiar with UTs, the Nikko AM Shenton short-term bond fund, that has also been pretty volatile as well. So this 2% drop is not something that we are used to seeing, but it was in fact still one of the more resilient parts of our portfolios. Especially if you compare to the global bond benchmark, which was in fact down by 6.2%. So we have actually added the Chinese government, some Chinese government bond exposure to our portfolios this year. And so far, this has added a bit of resilience to our fixed income portfolios. But on the other hand, we also have exposure to areas that have not been performing well, primarily Asian high yield. So this one is the worst performing fund in our portfolio right now. This one is down by more than 13%. Because of rising defaults in China's property sector. But there has also been a bit of a stabilization recently because of the Chinese government's pledge to stabilize the property sector. And there has also been a further relaxation of policy measures over the quarter. Okay, so that's all for the MAPS performance review. I have highlighted quite a number of changes that we have done to our MAPS portfolios. So over the next few slides, I just wanted to just go through some of these changes that we have made to our portfolios, as well as explain some of the rationale behind why we have made certain changes to our portfolios. So the first change that we did was to initiate exposure into value stocks. So value and growth are two fundamental styles of stock investing. So when you hear people talk about value stocks, they are essentially referring to companies that have good fundamentals, but their valuations are cheap. Growth stocks, on the other hand, they are essentially companies that are expected to deliver high levels of earnings growth in the future. And there are certain areas and certain sectors that are typically associated with value and growth. So for value, examples are like your financials, energy stocks. So these are typically value-oriented sectors. Growth is an area that has been dominated by technology stocks. And as you can see very clearly from the chart on the right, growth stocks have actually been the one that is outperforming value stocks over the past decade. So how you interpret this chart is anything that is below zero represents growth outperformance, and anything that is above that, it represents value outperformance. So you can see in the past decade, since 2010, growth has in fact been the style that has been outperforming. And 10 years is actually a very long time. And so it's easy to forget that in the decade before 2010, value was actually the style that was outperforming. So the massive rotation that you see from value to growth from 2010 onwards, this was largely because of ultra easy monetary policies. Low interest rates can justify high valuation for stocks. It doesn't matter whether a stock is profitable or not. As long as it has a good story to tell, investors were willing to pay up for the stock. But the next decade in front of us is likely going to be very different because we now have a new environment of higher interest rates and higher inflation globally. And investors are now, of course, more disciplined when it comes to stock valuations. And this macroeconomic environment of higher interest rates and inflation is actually supportive of value stocks in general. Value stocks, they tend to outperform growth stocks during periods of high inflation and rising interest rates. And you can see from this chart that there is actually a very strong correlation between value performance and inflation. And there is a logical explanation for this because value-oriented sectors like financials, they generally benefit in rising interest rate environment. Energy and materials, which are also considered your value sectors, they benefit in a high inflation environment because commodities, they tend to be good inflation hedges. Technology stocks, on the other hand, they suffer in a rising interest rate environment because of their valuations tend to be reliant on future profits. So the higher interest rates go, the lower the present value of that future stream of earnings, which is why value stocks, they tend to outperform in a high inflation and also a rising interest rate environment. And we have already seen value stocks outperforming growth stocks this year. In terms of valuations, even though value has already started to outperform growth, their valuations still remain attractive because they are still trading at a wide discount to growth stocks. So there is still a lot of room for value to catch up to growth in terms of performance. So are we about to see a massive rotation back into value over the next decade? I think that's a possibility. But of course, in our minds, the debate is not so much about whether one style is better than the other. For us, the primary consideration is more on the concentration risk that we have in growth stocks. As I've shared earlier, we have a number of equity funds that are overweight in growth sectors. So we have initiated exposure into the JPM US Value Fund, as well as the HSBC Europe Value Fund, as a way for us to achieve greater diversification for the portfolios. Value may be attractive today, but if we just bet on a single style, it is also quite risky, especially if the fundamentals don't play out. We also recognize that there are advantages to growth investing because technology, it is a mega trend. This digitalization of the global economy will continue, whether we like it or not, and whether interest rates stay low or not. So at this point, I think the most prudent thing for us to do is to hold a combination of both value and growth stocks. So we have decided to initiate exposure into value stocks to provide this important element of diversification for our portfolios. So that's the first change that we have done. The second change that we did was to introduce a natural resources fund into our portfolios as a tactical idea. And one of the main reasons for that is because we think commodity prices, energy prices especially, they will likely remain higher for much longer. So the geopolitical crisis between Russia and Ukraine, so that has obviously been the main driving force behind higher oil prices in recent times. But there are also other factors that will keep oil prices high in the years ahead. So firstly, you have a lack of upstream oil and gas investments. So in the past, the industry, they will usually respond to very good energy demand and also higher oil prices by investing to drill more oil. But you don't see that happening now because of climate change. And investors have been giving management a lot of pressure to decarbonize their operations. So there is this pressure on these oil companies to not invest in more exploration of oil and gas, upstream oil and gas investments. And even if oil companies are willing to invest, it will actually take several years before production can be ramped up meaningfully. So in the short term, at least in the few years, in the 2 to 3 years ahead of us, we expect supply to remain tight. And secondly, on the demand side of things, we actually still depend a lot on fossil fuels for our energy needs. And there is currently not enough investments in renewable energy to completely replace fossil fuels. So the transition to clean energy is going to take a long time. And what that means for us and also for the world is that we are still going to need a lot of fossil fuels in the foreseeable future. And the lack of investments in oil and gas will only lead to higher energy prices in the coming years. And even if right now there is a ceasefire or a peace treaty between Russia and Ukraine right now, I don't think oil prices are going to come down substantially because Europe is definitely not going to go back to Russia for its energy supply because Russia has weaponized energy. It is using energy to blackmail Europe, and Europe is definitely not going to depend on Russia for its energy needs. And for anyone else who wants to buy Russian oil, it now comes with reputational risk because you will be accused of financing war and violence. So nobody will want to touch Russian oil. And those who want to buy Russian oil because it's dirt cheap right now, they run the risk of having reputational risk, and they may also be subjected to sanctions. So I'm guessing not a lot of people will want to touch Russian oil. And this also means that if they don't touch Russian oil, they will chase the limited supplies that are out there in the global market right now. And this is going to push up prices further. So oil prices are going to stay higher for much longer. And besides energy, materials is something that is also in high demand, especially those materials and metals that are involved in a green transition. So I've listed a couple of examples on my slide, such as your lithium, cobalt, and nickel. These are key inputs for batteries that are being used in the electric vehicles today. And also metals like graphite, rare earths, copper. These are all metals that are used in wind and solar technologies. So this transition to clean energy has in fact created a structural demand that is going to be beneficial to companies that mine all these important green metals. But yet at the same time, supply has not been able to keep up. We currently do not have enough materials to hit net zero. And if the world is to overcome climate change, we will definitely need a greater supply of materials. But for now, this gap between materials demand and supply is expected to drive up prices for metals. So natural resources like oil and metals, they have also typically been good hedge against inflation. So in a high inflationary environment, they typically outperform other asset classes. And you can see also very clearly from this chart, there is a strong correlation between the performance of commodities as well as US inflation. And this further highlights the effectiveness of using commodities as an inflation hedge. And the bonus for investing in energy and materials right now is that they actually give quite good dividend yields of about 4% on average. And you can also see that these two sectors, they are currently giving the highest yields across all the different sectors in the MSCI World Index. So that's the second change that we have implemented. We included natural resources as part of our technical exposure. So over in the fixed income side of things, we have also done some fine tuning. And one of the things that we have done is to add Chinese government bond exposure into our fixed income portfolios. So Chinese government bonds, we think it's actually quite interesting now for a couple of reasons. So from a yield perspective, Chinese government bonds, they offer much higher yields compared to what you can potentially get from other developed market government bonds. So if you look at this table, Chinese government bonds, they are in fact offering yields of about 2.8%. This is as of 31st March. And this is in fact one of the highest in the developed markets right now. And if you take into consideration the impact of inflation, then China is actually the only market that is offering positive real yields for investors. And this 2.8% yield is, like I said just now, is as of 31st of March. But at the point when we decided to include Chinese government bonds into our fixed income portfolio, the yield was actually much higher. And the appeal of Chinese government bonds back then was a lot higher compared to the current yield levels right now. And also in terms of their credit quality, Chinese government bonds, they are given an investment grade rating of A+, and this is actually by S&P. And this A+ is equivalent to countries like Japan, which is also A+, and it is also better than Italy's credit rating of BBB. And also compared to UK and France, it's actually just a couple of levels. In fact, just 2 levels below the credit levels of UK and France. So Chinese bonds, they can be considered a safe haven asset. And more importantly, China's monetary policy is going on a different path compared to the rest of the world. China is actually shifting towards easing when the Fed is planning to hike interest rates. So this divergence in monetary policy and this shift towards monetary easing in China, this is expected to help support bond prices. And Chinese government bonds, they have shown themselves to be reliable safe havens over the past year amidst the volatility in global bond markets. And we can see from this chart, since August 2021, the US 10-year government bond yield, they have actually risen from about 1.1% to about 2.4%. So that's about an increase of about 1.3 percentage points. Compare this to the yield movements for the Chinese 10-year government bond yields. So you realize that it has been fluctuating in a tight range of between 2.5 to 3%. So that's only about 0.5 percentage point. So this lack of a volatility in Chinese government bond market, so that's one reason why we think they can potentially offer diversification benefits as well as a slight yield pickup for our fixed income portfolios. And also, if you look at the longer term correlation of Chinese government bonds with other fixed income markets, you also realize that they are a very good portfolio diversifier because historically, Chinese government bonds, they have very low correlations with other major fixed income markets. In fact, if you look at the correlation between Chinese government bonds and US government bonds, the correlation is actually near zero, which means close to no correlation at all. So we emphasize again that Chinese government bonds, they can be a good alternative for fixed income investors, especially against the current backdrop of a rising interest rate environment. And in terms of the choice of product that we have selected for our portfolios, we have actually chosen an ETF for exposure to Chinese government bonds because in the UT space, there isn't any fund available that can give us dedicated exposure to Chinese government bonds. So we have opted for ETFs. And these were just some of the ETFs that we have considered including into our portfolios. But we end up choosing the one by CSOP. This one is, this ETF by CSOP is actually listed on SGX. Its expense ratio is only 0.25%. So it is a very cost-effective way for us to gain exposure to Chinese government bonds. Across all the different Chinese government bond ETFs, this ETF is also the largest, and it also has a Sing dollar share class available. So all things considered, we have opted for this CSOP FTSE Chinese government bond ETF listed on the SGX. So the last change that we have implemented in our portfolios was to downgrade global high yield bonds. And the main reason for that is because we feel valuations are getting a little excessive because not only are we seeing bond yields that are near record low levels, but also if you look at the credit spreads of global high yield bonds, the credit spreads is essentially a measure of the compensation that investors are getting for taking on additional credit risk. And you can see that spreads for global high yield bonds, they have tightened very substantially. And even though there has been an uptick this year in terms of the credit spreads, it is still below the long-term average. And also relative to historical levels, you see that this is actually not very attractive at this point. And also, if you look at the CCC rated corporate bonds, CCC credit rating is in fact the junkiest of the junk bonds, the highest risk of the high yield bonds. If you look at the yield and credit spreads for this CCC rated US high yield bonds, you will also realize that yields are at record low levels. So in the process of searching for higher yields, investors have been snapping up all these high yield bonds over the past year like hotcakes. They have in fact been accepting less and less reward in exchange for more and more risk in the high yield market. And there are also other warning signs that the high yield market has been overheated. So one of which is actually the record issuance of high yield bonds by US and European issuers over the past 2 years. And this trend has actually been driven by the fact that a lot of companies, they have taken advantage of the low interest environment to issue new bonds. And here's where the danger comes in, because interest rates are going to rise. The Fed has already started his rate hike cycle, and quantitative easing is ending. Quantitative easing is now replaced by quantitative tightening. And this means that borrowers will soon find themselves having to repay the debt or refinance their bonds in a market that is about to see sharply higher interest rates. And this could potentially lead to an increase in defaults among your high yield issuers. And on top of that, lending terms have also become much easier. As indicated on this chart, there has been a decline in bond covenant quality, which is currently still at its weakest levels. So bond covenants, they are usually there to protect the interests of the bondholders, because these covenants, they help to ensure that issuers, they operate within certain boundaries so that credit quality is at least maintained at a certain level. So in the absence of these bond covenants, in the absence of these protection for bondholders, they usually they demand a higher yield to compensate for the additional risk that they are taking. But you don't see that happening. In fact, if you look at the bond covenant quality, they have in fact been worsening over the years. And also, as I've shared in my previous slide, yields have been declining as well. So investors, again, they are taking on more and more risks, and at the same time accepting less and less reward. And this is a worrying trend, because bonds that have lower covenant quality, they tend to offer limited protection to investors. And if these bonds default, the recovery rates for these high yield bonds is likely to be low as well. Of course, we're not trying to say that the US high yield market is going to implode or going to crash anytime soon. It probably won't, especially if interest rates still remain at its current low levels and corporate earnings continue to recover rapidly. But we all know interest rates are going to rise, whether you like it or not. And given that there is very limited margin of safety for high yield bonds right now, any unexpected setbacks, such as a worse than expected earnings or economic growth, or even a more aggressive rate hike cycle by the Federal Reserve, all of these factors will definitely lead to a pullback in the global high yield bond market. So we don't think spreads at this point are compensating investors well enough for the risk that they are taking in this fixed income segment. So as a result, we have actually reduced our exposure to US high yield bonds. Okay, and so in total, we have made 4 changes to the MAPS portfolios over the past quarter. And right now, just moving on to the last part of my presentation, I'll be discussing some of the issues that are top of mind for investors right now, and how we will be positioning our portfolios for the year ahead. So I think the key question right now is really this: is a recession coming? With commodity prices surging, oil prices at 130 a barrel, inflation, Fed rate hikes, all of these factors make it look like a recession could be coming. And some investors, they also point to the yield curve inversion in March as a strong signal that a recession is about to come. So this yield curve inversion is it's important and psychologically very significant, because it has historically been a reliable predictor of a recession. Because in the past 7 recessions in the US since 1978, a yield curve inversion has actually preceded a recession in 6 times out of these 7 recessions. 6 times out of 7, that's actually quite a good recession predictor. But having said that, I just wanted to say that this indicator is actually not perfect, and there are several reasons why we should not position our portfolios for recession just because the yield curve has inverted. So the first reason is because the yield curve has barely inverted. And the inversion has actually not lasted long enough. And if you look at this chart on my slide, if you look at the yield curve inversion that has preceded the shaded areas, which is the periods when the US economy has experienced a recession. So if you look at the yield curve inversion before the recession, you realize that the inversion actually persists for a couple of months before the recession actually takes place. So this time round, the inversion that we have seen in 2022 so far, it has only inverted for a few days. And as I speak right now, the yield curve has already been uninverted. There is also the possibility that the Fed's QE over the years, and also the rush to safe havens this year because of the war in Ukraine, these events may have distorted the yield curve by suppressing long-term bond yields. And even if the yield curve does have predictive power, there is also a lag time before a recession occurs. And stocks can have the potential to do well in the period after the inversion. So we caution against overinterpreting the yield curve inversion at this point. And don't forget also that 2/3 of the US economy consumer spending. So the financial condition of consumers in the US is another important factor to consider when assessing the probability of a recession over in the US. And there is some good news on this front because consumer finances in the US are actually in pretty good shape. US consumers, they are sitting on more than 4 trillion of cash as of end 2021. And this is all thanks to the generous stimulus measures by the US government to support the economy through the COVID-19 pandemic. And during the first quarter earnings call by some of the largest US banks, one common theme that has been highlighted across all the management is that consumers are sitting on a lot of cash and their finances are in good position at the moment. So there is this cash buffer that can help to cushion any negative impact arising from inflation and higher interest rates. So back to the question of whether a recession is coming. A recession is actually not our base case scenario at this point. We acknowledge that the risk of a recession has indeed become higher over the past quarter. But yet at the same time, even though there is a lot of headwinds in the global economy right now, there are also tailwinds and there are also other mitigating factors that could help support the global economy. So the likely result is probably not a recession, but rather a slowdown in global economic growth. But I think ultimately at this point, I don't think anyone can know for sure or predict with confidence whether a recession is indeed coming. But to prepare your portfolios for a recession right now, just because the yield curve has inverted, I think that's a little bit too premature. And don't forget also, the second largest economy in the world right now is in easing mode. China is in easing mode right now. And China is facing a lot of pressure on its economy right now, but the government is doing all it can to stabilize the economy. They have been issuing bonds for infrastructure investments. They have been selectively cutting taxes. They have been cutting their lending rates, and they have also reduced the bank reserve requirement ratios as well. The government has also been more supportive towards the property market, which is a key component and one of the more important components within China's economy. And for the property market, the Chinese government have in fact been easing up on their mortgage lending. They have been cutting mortgage interest rates, and they have also been making it easier and more flexible for the Chinese population to purchase properties. And you can see that all these measures are starting to take effect. As you can see from this chart, there has in fact been an acceleration in the growth rate of China's total lending in its overall economy. And the government has room for more stimulus because they still have leftover funds from last year that they didn't finish spending. So they so that can still help the government to provide some fiscal firepower to the Chinese economy. And there has also been sweeping statements from the government and also from the president, Xi Jinping himself. All these statements that pledge to stabilize the economy also suggest that more support is actually on the way. So the central bank, on its part, they have also been pledging more monetary easing measures to help to support the economy. Unfortunately, at this point, a lot of economies, they have been slashing their GDP estimates for China. And a lot of them, they are increasingly unconvinced that China can actually achieve its 5.5% GDP target this year. As it is, if China doesn't do more for its economy, given the downward pressures that they are facing on its economy right now, if it doesn't do anything more, then yes, I agree that this 5.5% is actually very difficult to achieve because all these lockdowns and all these regulatory crackdowns on the property sector, for instance, these are exerting real downward pressures on the economy. So in order for China to hit its 5.5% GDP target, China definitely has to do more in terms of policy support. And this is something that we expect them to do because 2022 is a politically sensitive year for President Xi Jinping because he is seeking a third term as China's president. And he will want to show the world and also China that the country has managed to achieve great economic progress under his leadership. And to a certain extent, this 5.5% target is not just an economic growth target. This 5.5% target is also a policy message. It is a message to every corner of the economy. It is a message to all the local government officials, business owners, and any entrepreneurs that they should all align their activities with this 5.5% growth target. And it is also a message to investors that if the government sees that there is a risk to this 5.5% target, then the government will definitely come in to provide support for the economy. And don't forget also that China has rarely missed its economic growth target. So let's not be too quick in dismissing China's growth target. So as a result, we continue to maintain our positive stance on China. So right now, there are obviously a lot of things to worry about for China. You've got the regulatory crackdowns over the past year. You've got a crisis in the property market, COVID-0, the lockdowns, and also its relationship with Russia. So a lot of things to worry about. But I think it's also fair to say that a lot of this negative overhang has already been priced into the markets. In fact, I think there is extreme fear in the Chinese equity market right now. There are many reasons that investors can think of to sell Chinese equities, but it is very difficult for investors to think of reasons to buy. And also, if you look at this V-shaped recovery in Chinese equities in March, during which markets actually sold off sharply in response to China's relations with Russia and also the risk of a delisting, and rebounded again after China came out with more policy statements. So this V-shaped recovery happened in a span of just 2 days. And I think it's fair to say that there is a lot of fear in the Chinese equity market right now. But with the government now shifting to more supportive policies, I think this could be a potential catalyst for China to turn around its performance in 2022. I know for some of you, you may be skeptical over the Chinese equity market, which is understandable because investors have been burnt time and again by Chinese stocks over the past year. But I'd just like to appeal to all investors and everyone who's here today to keep faith in China's equity market because the government's policy stance, they have been getting clearer and softer with every passing month. And the latest development, the latest decision to allow US regulators to gain full access to auditing reports of US listed Chinese companies. So this is actually a rare concession. This has been a critical headwind, and if it eases, then this should be a strong catalyst for Chinese equities and also Chinese tech stocks to rebound strongly in a year ahead. So if policy tightening has been the reason why China underperformed over the past 1 year, then this turnaround in their policy stance will also be the main reason why China can potentially outperform this year. In terms of asset class preference, so at this point, we actually recommend investors to stay overweight equities relative to fixed income. And the rationale behind that really is because we think equities, they still have the potential to do well this year, despite all the uncertainties that we have, which includes the backdrop of a rising interest rate environment. Bonds will be vulnerable because this asset class is typically quite sensitive to interest rate movements. And also in terms of valuations, bonds are still quite expensive across the board and are offering very limited value, even after the sell-off and the volatility that we have seen in fixed income markets this year. But in the equity space, the valuations of most equity markets, they are still pretty reasonable. And as I've highlighted in my slides previously, there are still areas in the stock market that can benefit from the current macroeconomic backdrop of high inflation and rising interest rates. So it is because of these reasons we remain overweight equities relative to bonds. So there's been no changes to our inter-asset allocation in the first quarter. So at this point, we are still overweight equities relative to fixed income, and we will continue to maintain this positioning in the foreseeable future. In terms of our fixed income positioning, so we continue to maintain a short duration profile for fixed income. So within the investment grade space, we are overweight Singapore-centric bonds. And within the higher credit risk segments, we are underweight emerging market bonds as well as global high yield. But Asian high yield at this point, it looks attractive. We think the markets have already priced in a lot of negatives. It is currently offering very attractive yields and spreads. In fact, one of the most attractive in the fixed income space right now. And like I mentioned just now, with the Chinese government now appearing to be easing some of its property market policies to prevent contagion in the sector, then we think that Asian high yield also has the potential to recover in 2022. Within equities, we are underweight the US, largely because of its expensive valuations relative to other markets. For Europe, we are still neutral, and we also have overweight positions in Japan. And outside of developed markets, we have overweight positions in Asia ex-Japan, as well as the Chinese equity market. So just to summarize my presentation today, so we think recession risks are rising, but the recession is currently not a foregone conclusion. If you position your portfolios to prepare for a recession right now, you could potentially miss out on potential gains. So what we will be doing is we will continue to maintain our overweight position in equities, and we will also seek to diversify our portfolios and also to tweak our portfolios and allocations to prepare for a new environment of high inflation as well as rising interest rates. And before we go to Q&A, I'd just like to take this opportunity to highlight that we have actually recently lowered our minimum investment amounts for MAPs. So from the 25th of April onwards, we have actually reduced the initial minimum investment amount from MAPs from $1,000 to just $500 right now. The subsequent minimum investment amount that has also been lowered from $500 to just $100. Regular savings plan, the minimum has also been lowered to $100 from $500 previously. So if you don't have enough capital, or if you don't want to commit a large sum of money to MAPs, then the good news for you is that you can now invest in MAPs in small amounts, and you can gain access to a diversified portfolio with as little as $100. Okay. So with that, I've come to the end of my presentation today. So thank you very much for your support for MAPs, and thank you also for taking the time to attend today's session. So right now, I'll just hand the time back to Sarah.
Thank you, Weiren. So thank you again to all attendees for joining us for this webinar. We hope that it really brought a lot of clarity on the changes to MAPs as well as how you should position your portfolios. So with that, we've come to the end of the webinar. So stay tuned to our upcoming events on our website. So you can go to www.fsm.com. We always publish our upcoming webinars as well as events there. So we do have an upcoming, one of our bigger scale events called ETF Festival that's coming out on 14th May. So it's really all focused on ETFs, but we also do share a bit of our macro outlook for the rest of the year. So if you're keen on joining us, you can head over to etffestival.fsm1.com to register for this event that is held online. So I'll be pasting the link in the chat function. You can copy and paste after this session ends. So with that, I'll conclude it. Yeah, thank you and take care.